Let's bring in Elise Ausenbaugh. She's global investment strategist at JPM, a private bank, and we're hoping we get Ethan. I've been practicing Ethan's name for a while, Becky. Aoifinn. Ethan Devitt. Yeah, it's a cool name.
It's a good name.
We'll see whether we get Ethan in just a minute. We'll start with Elise. So, Elise, you point out that PCE might confirm some recent good news on the inflation front, but the PMI reminds us that it's not. It's still stuff to worry about. It's not going to be a smooth ride, and there's going to be bumps along the way. And earnings have not been that good, and probably the market has done well this year. That might be different than the actual economic backdrop.
Indeed. I think when we kind of think through all of the data that we've been getting so far this week, one of the most notable headlines that caught my attention yesterday was the fact that America's largest private employer is increasing that starting wage to the tune of 17%. Granted, when you look at their average hourly wage, that's up only 3%, but it's things like that that are a reminder that we're not yet out of the woods when it comes to inflation. And so the Fed's going to continue to talk tough. We should expect interest rates to, remain somewhat elevated at current levels. We are looking for them to fall into year end. But in the meantime, that leaves us a little bit skeptical about this recent rally, given that you're, just not able to really see a scenario in which the multiple can move that much higher, and you've got the earnings, which are, starting to come down towards our outlook levels.
Yeah, you're talking about Walmart, and Walmart, Doug McMillon does, he's a stakeholder guy. He loves his employees, but nobody does. They went to $14 from $12, I think. That's what you're alluding to, at least. But that just highlights it's tough to get workers, because he's not doing it just for workers. It's tough. You need to offer that to bring them on board.
Exactly. And that's why when we're thinking about inflation and talking about inflation right now, just like the Fed, I think that narrative has shifted. This is really about the tightness in the labor market at this point. And so as we continue to see these headlines of more and more employers starting to lay workers off, and if and when we see that broaden out from not just these tech and financial companies that, kind of went on a hiring spree throughout the pandemic era, I think that's the point at which we would say, okay, this is all coming home to roost. The recession is coming to fruition. And when we can get really excited about starting to pound the table on adding risk. But in the meantime, what we're doing is anchoring on those defensive buffers in portfolios and barbelling them with, adding exposures to areas that we think are already reflecting sufficient recessionary type pain, at least here in the United States.
Ethan, you made it. Ethan Devitt, CIO of Moneta. And I don't know. I'm worried for you. You're managing $33 billion. That just seems like a really important important job. Thank you for joining us. I'm glad we were able to get you in here. What are you doing at this point to manage that type of money? Is fixed income attractive all of a sudden again, maybe for a balanced portfolio?
Clients about obviously 2022, which was quite damaging on both sides of the portfolio, unprecedented really for that. And we're speaking to them about maintaining their focus, maintaining their core exposure across our equities, staying balanced in value and growth. We've been saying that for a long time. It's been difficult to make that case for value. Although, of course, as your previous guest said, it now is when all the defensive areas are starting to rally, and we're enjoying that. We're enjoying seeing that that's coming through. The other area we've been, if we'd say, pounding the table on has been maintaining that global exposure. That's been very difficult to stay the course, obviously, as the dollar has been strong and as non-US markets have lagged for now coming up on 15 years. And now when we see that that's beginning to revert to the mean, again, it's a validation of maintaining that global portfolio. The other area where GLAD has been added to clients' portfolios slowly over the last little time has been alternative exposure, such as infrastructure, real assets. They were there as inflation hedges. We're glad they were there. They provided some essential ballast. And then, of course, we go into alternative assets too, which do give that just a non-correlated type of exposure, which has given some ballast again. But we're having conversations on all these fronts, and definitely around the relative attractiveness of fixed income and bond yields at this time.